Good morning, students. Today we'll be covering Module 2. So, I am Shinki Katyayani Pandey, currently working as Head of the Department of Faculty of Commerce and Management in Kalinga University. So, as we were talking about accounting, how it helps the decision makers of a company to make effective choices by understanding the financial status of the business and how economic events, their identification, measurement, recording, communicating the financial statements to the users of the information is important. The course will mainly focus on the theoretical framework of accounting, accounting process, the preparation of statement, understanding and interpretation of financial statements that will be helping the stakeholders to understand and interpret the financial position of a business in a very transparent and a very fair manner. This course will also focus on the emerging needs of computer accounting in the present business environment, as the use of technology will help the business in having the more accurate, reliable, and secure data which will be used as the information so that the policies can be taken more accurately and it will help the decision makers of a company to make effective choices among the various options available. So, talking about the module 2, it is about the accounting process. Accounting process will mainly consist journals, ledgers, subsidiary books, trial balance, final accounts, and depreciation. So, let's move on to module 2 and have an understanding of what are journals and ledgers. So, first talking about journals, journal is an initial book of entry where all financial transactions are recorded in a chronological order. Each entry in the journal includes the data, accounts affected, a brief description of all the transaction, and the amount or the monetary terms involved. This process of recording transaction in the journal is known as journalizing. Next, we'll be talking about what is ledger. Ledger is the next step after journalizing. So, the ledger is a collection of accounts that shows the changes in each and every account as a result of past transactions. It is a principal book, or you can say a main book of accounting, where transactions from the journals are posted to individual accounts. Journal will be helpful in summarizing and classifying the information. So, after the first thing that we do is journalizing, the next step in accounting is known as ledger or ledger making, which will be helping in summarizing and classifying. Next, we'll be talking about the subsidiary books that we have to maintain in every accounting year. So, what are subsidiary books? They are special journals used to record specific types of transaction in a summarized form. The common subsidiary books will include cash book, sales day book, purchase day book, sales return book, lastly purchase return book. So what is cash book? So cash book will be recording all the cash transactions in the business. Cash transaction means where the monetary transaction or the monetary exchange has happened. Next, we will be talking about the sales day book, or commonly known as sales book, which will be recording all the credit sales. Credit sales means whereby still we haven't received the monetary exchange in return. Still the sales isn't credit. That means we haven't got the amount for the same. Next is purchase day book, or commonly known as purchase book, which will be recording all the credit purchase. Same ways that we have talked about the sales book, same ways credit purchase, whereby till yet we haven't paid for whatever we have purchased, or we will be paying it in future. All the transactions of this nature will be recorded in purchase day book. Next, we'll be talking about sales return book. So, sales return book is the record of all the goods returned by a customer to a business. Next, we'll be talking about purchase return book, which is a vice versa of sales return. That is the return of goods returned to the suppliers by the business. The reasons can be any. The goods can be defective, the goods can be extra, or the goods can be not as per the demand of the customer or the demand of the business. Hence, they have returned either back to the business or the business has returned back to the suppliers. So, these books helps in maintaining a systematic and organized record of transactions. This was all about the subsidiary books. The next topic of ours is trial balance. So, this is the next step after we complete the journalizing, the ledgering, the preparing of all the subsidiary books. The next is trial balance. So, trial balance, what it is all about? It is a statement that lists the closing balance of all the ledger accounts at a specific point of time in the business. The purpose of trial balance is to ensure the equality of debts and credits and to identify any errors in the accounting record, which is a human error or it is a system error that might have occurred while recording the transactions. If the total debit is equal to the total credits, the trial balance is considered to be balanced. But if the total credits and the total debits are not balanced or they are not equal, then we have to identify that is there any error in the accounting records that were done previously. So, this was all about the trial balance. Next, we'll be talking about the final accounts or the last step of accounting, which is final accounts, that refers to the preparation of income statement and the balance sheet at the end of any accounting period. In India, the accounting period accepted is from 1st April of any year to 31st April of the upcoming year. So, we talk about the accounting period as 1st April till 31st March. So, the first final accounts we talk about is the income statement or generally known as profit and loss statement, which summarizes the revenue and the expenses of a business during a specified period of time or generally known as an accounting year, resulting in either a net profit or a net loss. Next, we'll be talking about the balance sheet. Balance sheet provides a snapshot of company's financial position at a specific date. The specific date generally accepted in India is the last date of the financial year, which is 31st March of each year. It includes the assets, liabilities, equities that will be showing the accounting equation as assets will always be equal to liabilities in the summation with the equity of a business. Next topic of ours is depreciation. Depreciation, as we all know, it's a systematic allocation of the cost of a tangible asset over its useful life. It reflects the decrease in assets value over time due to factors such as wear and tear, obsolescence, or usage. Common methods of calculating depreciation includes straight line depreciation, declining balance depreciation, and unit of production depreciation. In India, we talk about straight line depreciation and declining balance depreciation methods for calculating the depreciation on any fixed asset. Depreciation is important for matching the cost of an asset with the revenue they generate and for the accurate representing the asset book value on the balance sheet. These concepts are fundamental in the field of accounting and are crucial for maintaining accurate and reliable financial records. There are several methods of depreciation used to allocate the cost of tangible asset over its useful life. The choice of depreciation methods depend on factors such as the nature of the assets, its expected pattern of use, and the relevant accounting standards. Here are some of the common methods of depreciation that are used in India. So, first method we'll be talking about is straight line depreciation. So, what it is the method that allocates an equal amount of depreciation expense each year throughout the useful life of an asset. The formula for this method is annual depreciation expenses will be equal to the cost of asset minus the residual value of the asset at the end of the period or the end of the life of an asset divided by the useful life of an asset. Next, we'll be talking about the declining balance method, also known as diminishing balance method. It talks about the results in higher depreciation expense in the earlier years and decreased over time. This depreciation rates is applied to the book value of the asset. So, the formula for this method is annual depreciation expense is equal to book value at the beginning of the year multiplied by the rate of depreciation that is charged on the asset. Thank you so much. This was all about Module 2.